are going to get started with our next panel, the sub-advisor panel. For those of you who don't know me, I'm Mitch Burton. I'm an assistant portfolio manager here at AAM. At AAM, we use a highly disciplined approach to selecting our specialized investment partners. And today, I have the honor of introducing a few of these key partners. We have Pretti of Zazove Associates, Vikram Awashti of Muzinich & Co., and Alex Rapoport of Affinius Capital. Moderating today's panel is Kevin Adams, Senior Portfolio Manager. And without further ado, I'll let Kevin take it and go.
Thanks, Mitch. First off, good morning, everyone. Thank you all for attending the session. I'll be moderating this roundtable session with AAM sub-advisory partners, Alex, Vikram, and Gene. We're going to start the session, and we'll be asking for their insights on the current environment and the outlook for each of their strategies. But before we do that, I'd like to just spend a little bit of time and give a brief overview of each of their strategies, and then we'll follow up with questions. So with that, I'm going to begin with a high-level overview of the asset classes that we'll be covering today. And the first asset class is high yield and bank loans. What are high yield and bank loans? Most of you probably know high yield, maybe not bank loans so much, but essentially the companies that issue in these segments are sometimes the same, they overlap, but they are below investment grade rated companies, so they're companies that are rated Ba1 by Moody's or lower, or BB plus by S&P and Fitch or lower. The difference between high yield and bank loans is that high yield issuance is fixed rate coupons or tends to be fixed rate coupons, and the debt is typically senior but unsecured or subordinate. Whereas on the bank loan side, you tend to have a floating rate coupon instead of a fixed rate coupon, and the issuance tends to be secured. Now, the other sector that we are going to be talking about are commercial mortgage loans. Those are pretty much what they sound like. They are loans secured by real estate, so we're talking about multifamily properties, office buildings, industrial properties, hospitality. And payment is typically supported by the property's cash flows and the value of the property itself. And then last, but certainly not least, are convertible bonds. So those of you who aren't familiar with convertible bonds, a convertible bond is a bond. You have a bond, a coupon, a maturity date, but it also has a warrant attached that is exercisable into the equity of the issuer. So with that, I'm going to turn it over to the experts and let them take a moment to talk about some of the themes that they're seeing in each of their segments. And we'll start with Vikram and high yield and bank loans.
Thanks, Kevin. So I am a portfolio manager at Muzinich, where I manage our high yield mutual funds and separately managed accounts. So a lot of our strategies also have bank loans in them as well. So some of the key highlights and developments that I think not many people appreciate today about high yields, which you'll see up on the screen here, is basically since the Fed started raising rates in 2022, you've seen a significant migration of risk out of high yields. A lot of leveraged borrowers started issuing more in leveraged loans and in private credit. And what that has resulted in a market that's always been called junk bonds has actually become less junkier than it has been in the past. So BBs are now almost 60% of the market. And on top of that, duration is actually shortened quite a bit. So you're looking at a market that has duration of around 3, BBs around 60%. And typically when you have lower duration and higher quality, that means lower spreads. So I think one of the things that a lot of people, when they come to us and they ask us about high yield, they say, well, spreads are just so low relative to history, but there's a real reason for that. And that's for the quality migration and the duration shortening of the market, which has effectively made it a much higher quality and lower volatility asset class over the last few years. I think if I were to give you a ranking of just kind of credit risk within leveraged corporate credit, I would say high yield is probably the highest quality, followed by leveraged loans and then private credit. Whereas in the past they were kind of more on equal footing. With that said, leveraged loans also are an interesting space these days, but there's been a migration more towards single B borrowers. You can see on the screen here that single B, it's largely a single B market. So while you're certainly protected from duration and higher rates by also collecting higher base rates, the market has certainly seen an uptick in defaults. And obviously, when people these days are very focused on AI risk, software as a percentage of the market is around 16 to 20%. In private credit, there's data out there that says software could be anywhere from 25 to 30%, whereas in high yield it's only 4%. So these are key distinctions that I think when people look at the market, they don't necessarily observe it, but I think helpful to share.
Thanks, Vikram. Next, let's move on to commercial mortgage loans. Alex, why don't you go ahead and give us an overview there?
Yeah, hey, good morning, everyone. And I've been with Affinius Capital for 12 years. I'm a portfolio manager, and I focus exclusively on making investments in commercial real estate credit, so that's debt, on behalf of insurance companies, P&C and life, throughout the U.S. and also globally. When you look at Affinius, we're a $63 billion AUM investor in commercial real estate. That's the only asset class we invest in. About two-thirds of our investments are in properties that we own or manage on behalf of groups. A large client there is USAA, which is what we spun out of, and they are, going back to 1982, really the sort of lifeblood of Affinius. But we've got a lot of pension money, sovereign money, and other insurance company money where we own properties and manage them on their behalf. We also make loans. That's about a third of our total AUM. We're never lending on properties that we own, so there is a bit of a wall or a separation there. But we lend through three main sort of credit products. We do a fixed rate CML product. That's sort of our core bucket, if you will. A lot of our life companies use that for asset liability matching. These are call protected. You can get walls as short as 3 years. You can get them out longer than 10 plus years. In today's higher interest rate environment, we're not seeing a lot of borrowers calling us looking for 15 or 20-year loans. But historically, in a lower rate environment over the last 4 or 5 years, we were able to get a lot of duration for USA and some of our other investors that helped in their longer-term annuity products. We have also got 2 closed-end fund series. One is in bridge lending. The other is in construction lending, and those have become very popular in recent years for insurance companies. I would say more on the life side because of look-through treatment, but also for P&C. Both of these present yield, and looking at what's on the middle side there are bridge loans. Those are loans on generally recently built product where the borrower wants to get off a construction loan. And if you look at what we're doing today, a lot of the inbound requests are in today's higher interest rate market. The sales market has been slow. You're a developer. You develop a nice multifamily property. You can't sell it yet. You're going to want to bridge it for 2 to 3 years and then try to sell. That is what's in that bucket. For insurance companies, again, that's a yield play, and there's more yield there than a traditional CML. The sort of IRRs or coupons are there on the chart. Lastly, what we do in construction lending, Affinius is effectively a non-bank lender, but we're doing bank-style loans. After the GFC and the overregulation that has occurred for a lot of regional and then big money center banks, non-bank lenders like Affinius are actually better positioned to make construction loans. And with our expertise owning and developing real estate now for over 40 years, it was logical we became a construction lender about 12 years ago. That fund is in a closed-end format. And, again, that is, think of a to-be-built warehouse, to-be-built apartment complex. That's the collateral that's in that fund. But as Kevin talked about earlier, everything that we're doing in lending, the collateral is commercial real estate. And again, we look at multifamily as commercial as well, even though it's residential. We don't do any lending in the single-family housing space. But those are our 3 main credit products. And over the course of this session, I look forward to kind of sharing how it's helped some of our clients or how they utilize it for asset liability matching or to provide yield, or both.
Thanks, Alex. Gene?
Sure. So I guess the theme in our market, or the headline, if you will, is issuance. And to put that in a little bit of perspective, for the last few years, issuance has been running very strong post-COVID, the convertible market being source of a good place for folks to raise capital. Kind of looking at the large-scale numbers, issuance peaked in 2020 and again in 2025, around $120 billion. To put that in perspective, our market's around $400 billion in size, so pretty substantial issuance. This year, we're on pace to probably exceed $200 billion in issuance, which would be an all-time record and significant growth in the marketplace. What's driving that is kind of the same themes that drive the equity market. So, like everything else in the world right now, AI is the theme. So we're seeing enormous amounts of capital being raised from AI and AI-adjacent companies. Arguably, roughly half of the market somehow now is correlated to AI. So that runs the gamut from everything from the data center operators, the semiconductor companies, the kind of the Mag 7, those type of folks, but also running all the way to, for instance, electric utilities and such. So we've seen a huge amount of issuance, a lot of it being in the AI space, as I said. But away from that, all the other sectors have been pretty steady issuers as well. So we're seeing really nice growth in the marketplace, and then that's kind of an opportunity set for us. So that's kind of the good news. The other theme in the market, which is maybe a little bit subtle, is the amount of single stock volatility that we're seeing is just staggering. Whether it be quarterly earnings announcements or other just kind of themes within the marketplace, the number of kind of 20, 25, 30% moves that we're seeing in equities on a daily or even a weekly basis is kind of mind-boggling, and in direct contrast to what you're seeing in the VIX. So, as you probably know, the VIX is overall level of market volatility. That theoretically should be an aggregation of single stock volatility. That said, the VIX has been declining ever since the war started and been kind of on a steady decline. Single stock volatility is still running very high. For us, that's kind of an opportunity in that if we do our job, we have the asymmetry in the convertible, in that if a stock goes down, we're protected on the downside, and if it goes up, we'll participate more so on the upside. So that volatility has been an opportunity set for us in the space.
Thanks, Gene. I'm going to touch on something a little different here. And each year, Goldman Sachs conducts a survey of insurance companies, CIOs and CFOs. And this past year, there were 434 respondents or responses to that survey. The survey was taken in January of this year. And I'll highlight some of the investment-related questions and the corresponding results. So on this first slide, the question was, rank the 5 asset classes that you expect to have the highest return over the next 12 months. And this was maybe not that surprising. You do see out of the top 5 answers, 4 of them are equity-related, which you would expect over longer cycles. Equities would have longer returns or higher returns. The one that surprised me a little bit was commodities. So if you keep in mind this survey was taken in January, the respondents were pretty prescient. Commodities are up on average about 20% thus far year to date. So pretty sharp there. Insurance companies tend not to invest in commodities directly because they focus more on income-producing assets. But from a top-down perspective, where do each of you currently see the most attractive risk-adjusted opportunities within each of your asset classes? And we'll kick things off with Vikram.
Sure. So we see the overall macro backdrop of an economy that's growing pretty nicely, but inflation is pretty sticky. Typically, in that type of environment, corporate fundamentals are pretty good, which they currently are. So we have generally been leaning into building a portfolio that's concentrated in single Bs. Single Bs today get you around 7.5% yields and have plenty of call protection and convexity, which can get you up to double-digit returns on a case-by-case basis. And we're barbelling that with double B loans in a lot of our portfolios. And the reason we're doing that is in an environment with sticky inflation, we can kind of replace a significant amount of double B bonds that have longer duration and more volatility and sensitivity to interest rates, and also get incremental carry over front-end bonds, which are actually only yielding around 5 to 5.25%, and replace them with double B loans, which are yielding around 6%. So that combination gives you higher yielding convexity, benefiting from a strong economy, and also gives you protection from duration and interest rate volatility in case the Fed starts to look to reverse course a bit.
Thanks, Vikram.
Yes, David. As an old guy, I was around for the birth of the high yield market. DLJ, you took that whole universe of history and looked at default rates, credit spreads on single B issues. Where are we in that long-term cycle? Given your essentially the question is, are you looking at tailwinds?
Yeah, I mean, I think if you look at the data today, it'll show you that default rates are at historical lows, which is what has followed, or spreads have effectively followed that as well. So spreads are also near historical lows. So you're kind of pricing in this low default rate environment, which if you look at just kind of projections, not only of our own internal projections, but also what you see kind of from the sell side is the expectation is that default rates are expected to stay relatively low for the foreseeable future. And that is the big reason for that is a significant amount of single Bs. While they might be single Bs, they're secured. A lot of LBO structures have moved out of the high yield market, so the single Bs that you see in the market are actually pretty high quality. And a lot of the low single B, which are B3, which actually have the step up in default rates, have actually started to shrink and become a smaller and smaller piece of the high yield market. So that's the reason why you're seeing tighter spreads and lower defaults.
One last follow-up question. Can you basically, high yield is a great asset class where defaults are going through the roof, credit spreads are gapping out huge levels. So what you're being asked by today seems to me you're betting against that issue.
You're betting against the issue of what the default rates will stay.
Default rates aren't going to rise, credit spreads aren't going to come down because the issues you buy today trade through the floor. That's proves to happen. And we're long in the tooth of been a long term. Half the people in the investment industry really haven't seen credit disaster.
Yeah, and I mean, I think one of the things that you realize when you've been a credit investor for a very long time is if you're going to sit tight and wait for the big next catalyst for spread widening, you're probably going to miss years and years of excess carry. So the question is, how long do you want to wait for that event when it's you don't really necessarily see one, and we haven't necessarily seen a big default wave in high yield in a while. So it's difficult for me to not allocate and out yields in an environment that looks very healthy and very constructive when there's really no catalyst for a widening event that I can foresee.
Thanks, Vikram. I'm going to direct that same question to you, Alex. Where do you see the most attractive risk-adjusted opportunities within the commercial mortgage and loan?
Yeah, when you look at commercial mortgage loans or commercial real estate broadly, it's a bit of a haves and have-nots. What we have seen over the life of number of cycles, but especially is holding true in recent years, newer vintage properties are outperforming the class sort of B and C. So where we invest either in equity or in credit is generally on more newly built, very functional Class A properties. I mean, believe it or not, there is a very big difference between a warehouse or even a self-storage facility that was built 30 years ago versus built 2 years ago. And when you look on the credit side of things, we focus especially on multifamily, industrial, self-storage. Retail, we focus almost exclusively on grocery-anchored, needs-based retail. So that is a very bifurcated market in terms of investor activity and lending versus, let's say, office. And even within office, we are starting to see here in recent years some green shoots. There's not been a lot of supply of new office. What is newer leases up, gets better rent growth, stays leased. B and C product that was built 40 years ago has really broadly underperformed. Opportunities today, if you're talking about making a loan on favored property types like multifamily or industrial, again, we have different ways to sort of skin the cat, if you will. We have borrowers that come to us at Affinius and they want a fixed rate loan that's lower leverage. We have a CML, that fixed rate product that I talked about earlier. We have groups, borrowers that come to us that have built a multifamily property and they want to get off a recourse-based bank construction loan and get on a bridge loan for a few years. So we have a project or a credit solution for that. And then in construction lending, even in today's higher interest rate environment, a lot of developers in certain markets look at the fact that, hey, warehouse supply has been coming down, we need to build. Same thing for apartments. So those favored property types, I'd say broadly coming out of the pandemic, have done very well. And generally in this higher interest rate environment that we are in our view at Affinius is, if you look at treasuries and where they're going, we don't see, we're going to be going back to the days of 5 years ago where people on my team were doing 3 and 4% mortgages. I think we're going to stay in that 5 to 6 plus sort of space. Overall, at the end of the day, that will constrain supply somewhat. And I think if you're able to build new apartments or do a bridge loan on new apartments, those will lease up well, because usually over cycles where real estate has gotten in trouble has been overbuilding. And I would say just here in recent years, there's been a lot of things cited so far this year. Construction is way down because it's expensive to build.
Thank you. How about you, Gene?
A little harder to answer in our asset class, but I'd say from a generic perspective, if you kind of take the overall view that single stock volatility is extremely high, credit quality within our space is very solid. If we do our job and optimize the asymmetry within the portfolio, you kind of benefit from that volatility without having to predict which way it is. That obviously the volatility is very centered in the momentum sectors, if you will. It's kind of largely technology, AI related, things such as that. The other thing I'd point out, something folks might not be aware of, is some of the new vehicles that exist within the equity market are really enhancing volatility. And what I'm getting at there is there's a lot of these leveraged ETFs that either they're leveraged on certain asset classes or sectors, if you will, or on specific names. Everything from 3 times the semiconductor index, et cetera. One of the dynamics of those is the more stocks go up, the more those funds have to buy. And you can literally see it at the close of the day, that if the semiconductor index has a strong day, if you look at a vehicle like the SOXS, which is a levered vehicle, they have to buy on the close enough to get their leverage back to 3 times. So it's a self-fulfilling cycle. It's obviously going the right direction right now. We all have to be aware that can unwind, and you'll have the same thing going the other direction if it ever happens. So there's things like that are creating significant volatility within our asset class. That's the nice thing about the structure of convertibles is, again, you can participate on the upside when it goes up, particularly if you optimize that asymmetry, and be protected on the downside if it declines.
Thanks, Gina.
Just a follow-up question, please, for Alex. The slide you had up, and you just talked about them now, about the bridge loans and then also the construction loans. So are those shown on Schedule B as in boy? I mean, it's my recollection that a number of states do not allow for construction loans, only permanent takeout. Have you run into that at all?
Yeah, that's a great question. Thank you for bringing that up. What we do in bridge and construction lending goes on Schedule BA, so that's in a closed-end fund format. I will say for the U.S. life insurance companies, they benefit there that there is look-through treatment. So you look through to the CM schedule, but it's not a Schedule B where you're reporting every individual loan. For example, the current iteration of our bridge lending fund is probably going to write 65 different mortgages over the life of that fund. They're not all individually going in B. There's a single line item in BA. And for U.S. life insurance companies, net of RBC, it's pretty accretive. But no, to your point, the traditional fixed rate permanent loan on a already built property, that would go on Schedule B.
Thanks, Alex. All right, the next question from the survey was rank the below issues that pose the greatest macroeconomic risk in order of risk to your investment portfolios. This was before the conflict with Iran, but that was over half of the respondents ranked that in the top 3, followed by an economic slowdown, a recession in the U.S., and then credit market and equity valuations, which is something they didn't have in 2025. That was a new question And then lastly, rounding out the top four was inflation. Gene, what are the biggest risks that you're monitoring today that investors may be underestimating as they relate to your strategy?
I don't know that they're underestimating. I think everybody's a little bit aware of equity valuations, et cetera, that, it's hard to argue that we're not in some sort of a bubble, particularly in the AI space, and how that plays out. We'll obviously, it's going to take some time to see. I think the big fear out there is the massive amounts of capital being invested in the space. Will they be able to generate a return on that justifies what they're doing? I'll cite the example of Google, and there's a handful of plays in that. One, these Mag 7 companies historically were massive cash generators. A lot of that cash went to buy back their own stock, so it was kind of a virtuous circle. Most of those companies have now turned into cash flow neutral at best, given the massive investments that they're making. So there's a change in the dynamic of the asset-light models that those companies had. But Google raised $80 billion about 3 weeks ago. Half of that was in the convertible market using a mandatory preferred. We suspect that you'll see significant amounts like that. And at some point in time, if the market realizes that returns may not be optimal for all this capital that's being invested, then this cycle could go the other way. So that'd be the big fear. Obviously, on a portfolio level, the way you manifest that is just monitoring what is your exposure to the sector overall, or the correlations that you have there, and then making sure that you've got the sort of the downside protection. The other aspect of that, in some of these entities, I think everybody's aware of sort of the circular nature of some of the investment within this space of, NVIDIA giving money to people that are buying their chips and then put them in a data center. The question is going to be for some of these financially levered entities, the CoreWeaves, et cetera, are those sustainable business models? That's the risk.
Thank you. How about you, Vikram?
I don't know if it's necessarily an underestimated risk, but I'd say one of the key fears that I have is inflation, and that we might be in an environment where, even excluding energy and food costs, which are obviously on their way down right now, core inflation continues to be perking a bit higher, and what the Fed's reaction function to that might be, and what does that do to cross-asset flows. So I think for me, it's more a question around how does that impact returns across various asset classes rather than necessarily fundamentals. But generally, if the Fed starts to raise base rates again, there could be some pressure on corporates that have a significant amount of exposure to floating rate product, whether that be in leveraged loans or private credit.
Okay, great. How about you, Alex?
I mentioned earlier the higher for longer interest rate environment that we're in. As a lender, obviously you like to hear that, but in commercial real estate, that can help you and it can hurt the market broadly. If you think about groups that were going out 3, 4, 5 years ago and getting a much lower rate loan, it's coming to maturity in a market where interest rates are much higher. There's refinance risk. You can see a ripple effect with things like that. We haven't seen it so far in the insurance lending space, where again, those are generally more conservative loans. But certainly if we're writing a construction loan or a bridge loan, we do think about what is this interest rate environment going to look like in 3 to 4 years where the loan comes due. So I'll kind of consider that 1A. 1B, we look very carefully at what's going on with the American consumer. It's a big reason that if we're looking at making a loan on an apartment or a self-storage property, we stick to more expensive rents, Class A properties. We're going for sort of a different income demographic, in terms of the profile of the renter, because you hope that they've got a little bit more wherewithal than someone that's in a more cut rate, Class B or C sort of, piece of collateral. But each of those, we spend a lot of time looking at data on. And again, our viewpoint is rates are going to be higher, and that can help you and it can hurt you depending on where you are in the capital stack.
Well, you bring up an interesting point about the higher for longer interest rates. Vikram, how do you see that impacting your markets?
The way you think about higher for longer is two ways. One, if you're a company that was able to strike your capital structure at low interest rates, let's say in 2021 or 2022, when The higher for longer really impacts you is when you have to go to refi and you have to step up your coupons from, let's say, 4 or 5% to 7 or 8%. That bites. And if you're a company that has low interest coverage, that can be problematic. So that's certainly an issue. I think it also raises the question around leverage buyouts that were also struck during that time, where a significant amount of the thesis was based off of rates staying kind of relatively low and resulting in either an expansion of multiples and within that space that that LBO might have happened, or resulting in significant amount of free cash flow from interest savings, two things that may be under pressure from a higher for longer environment. Again, I think a lot of that risk is something that you might see more in areas like leverage loans and private credit, where a lot of the kind of vintage deals that happened in that time frame will have to come to refi at some point and be pressured by an environment that's materially different.
Thank you. How about you, Gene? I know convertibles are a shorter duration asset, so it's not necessarily an interest rate play, but how have higher for longer rates impacted convertibles?
Other than just the mathematical input to what is a convertible worth, it's been fairly benign. I mean, from our perspective, you're talking about an asset class that's not very rate sensitive, so the sensitivity to rates being a little bit higher isn't anywhere near like you see in the fixed income markets. The flip side, and kind of going back to the volatility theme, within the convertible market, ironically, the higher the volatility of your stock, the lower your borrowing rate is. The short answer is not a big impact.
Thank you.
One thing I'll add is we are seeing part of the issuance demand is, as Vikram said, some of the paper being issued that was coming in the straight market with low coupons. Those folks refinance. Some of those folks are coming to the convertible market because it's a lower coupon way to refinance.
Thanks, Gene. All right. The next question, it asked CIOs and CFOs, are you planning to increase, maintain, or decrease the equity risk, credit risk, liquidity risk, and duration risk in your investment portfolio in the next 12 months? And what they recorded here was a net change. So if there are more people that are going to do that, then it would be a positive versus a negative. So you can see the number one risk to increase would be liquidity risk. I suppose perhaps this is a function of just trying to grab a little bit more yield and willing to give up some liquidity to do so. The second is duration risk, and we touched on the higher for longer interest rates. So insurance companies are willing to extend duration perhaps a little bit to lock in those rates. The next is credit risk, which I thought was interesting because that was one of the, even though it's an increase here by 14 points or net change, that was one of the highest risks cited in the concern part of the survey, but yet insurers are willing to increase that risk. Vikram, credit spreads, and we touched on this a little bit with David's question, credit spreads across most sectors remain near historically tight levels. Do you think investors are getting adequately rewarded for risk, and what level of default activity do you anticipate over the next several years?
Default rates are at historical lows, and most projections point to default rates staying relatively low compared to kind of historical levels that we've seen. I think the low spreads are a function of obviously higher quality migration, at least in high yield and in junk bonds, which I mentioned earlier are less junky than they used to be. The other function there is also lower duration risks. You expect to be paid on a spread basis, and in high yield, duration is sitting at 3, and that's an average duration. Most of the issuers are kind of sub 3 these days. There's some fallen angels that have actually driven the duration of the market much higher, but the preponderance of issuers are seeing average bonds that are between 3 to 5 years, and some of those trading above call prices, which drives the duration lower as well. So if you were to ask me, are you being paid adequately? From an all-in yield perspective, I think the answer is yes. From a spread perspective, I think spreads are okay. I can't argue that they're cheap, but I think that they're appropriately priced for the fact that duration is relatively low, and and default rates are at historical lows. So it goes back to the comment that I brought up when the slide was up on the screen, where double Bs, which used to be around 30% of the junk bond market, are now 60%. So that's a marketable, significant difference than what it used to be. And if you just look at default rates of double Bs, they've been relatively low historically.
Alex, I had the same question to you. That was credit spreads are near their historical tights. Do you think investors are getting adequately rewarded for risk and level default activity in your sector?
So for the fixed rate commercial mortgage loans that we originate, credit spreads there very much track what goes on in corporate IG bonds. Again, those are very tight. I would say, though, the delta is a little wider, the relative value, if you will. I think this time around looks better than it did, say, in 2018 when rates started rising. The ways that insurance companies can sort of manage that, a lot of our clients that are doing fixed rate CMLs, they will do spread borrowing with FHLB. So that's a way to take not a lot of risk, but frankly, you look at that on a levered basis and those returns can look very solid because, currently what we're doing in the CML space today, those gross credit spreads are in the low 200s to around maybe 195 over treasuries. But through pledging to FHLB, you can certainly on a levered basis exceed that. And then in our bridge and construction lending, those closed-end funds utilize back leverage. So that is how we are able to generate, in the case of bridge loans, that fund right now is clipping off a 10% net IRR. In construction lending, it's over a 12 net. We prudently use leverage at Affinius to enhance yield and not take on a lot of undue risk. And if you look in what we do in bridge and construction lending to the last dollar, the loan-to-value ratio based on a third-party appraisal, we're doing loans that banks were doing 20 years ago before the GFC. They're so regulated now, ironically, they get better capital treatment. Making a loan to Affinius and being in the capital stack with us, they don't want to be, in many cases, going out direct to borrowers or to sponsors. They rely on groups like Affinius to do that on their behalf. So there's no doubt that credit spreads are tight. We do see it day in and day out, but as you can prudently use leverage if you're an insurance company, either as an investor in our funds or utilizing FHLB, it can help.
Follow-up question from the recent question.
I was just curious as to how the junk bond market is getting less junky. Are you having A- drifting down, triple B minus dripping down into the double Bs, or are the single Bs or the double B minuses drifting up?
So you have seen a decent amount of fallen angels that have come into the market, and it's interesting if you just look at the overall forward returns of fallen angels, it's actually quite excellent because most of them actually somehow manage the problem that they were dealing with and end up becoming investment grade again someday. But there's also just been a general drive, I think, from the equity market that has pushed public companies to be higher quality credits. So a lot of the credits that have been in high yield for a very long time have had a lot of feedback from equity investors and tell them that your leverage is too high and we can't allocate capital to your equity unless you drive leverage lower. So you see it across multiple sectors where many issuers have worked for years to use cash flow to pay down debt and improve their credit metrics, which has led to upgrades and better fundamentals in the market. The universe has actually shrunk. Not only has it shrunk, but the duration has also migrated lower. So it goes back to the point of, I think, people look at the market and they say, well, spreads are low, but given that quality is higher and duration's low, it's actually a pretty good quality, low volatility market now, which 20 years ago you would never say about high yields.
So if you take your NAIC 1 and 2 product, okay, which it qualifies for essentially investment grade treatment, what do historical default rates look like correlated with rising interest rates? And then when you do have a default, what does recovery look like? Time to recovery, percentage recovered, what ultimately happens? And as a side question, what's the treatment during the default period from a RBC?
No, that's a great question, David. So I think as of the Q1 ACLI data, and they report, delinquencies, which consider that loans in default, that was right around 40 basis points. That number ticked up as COVID came on. That was driven heavily by office loans, which were by far the worst performing in that sector, or really anything in our universe of commercial real estate. As you have a loan that moves from a CM1 or CM2, which is, again, that's akin to an NAIC1, NAIC2, you migrate down the CM scale, your capital charge goes up. What you see, it depends on who the lender is. Some insurance companies there just want to do note sales. We've seen that with a lot of the very large groups where they have had some fire sales on notes on especially big downtown office buildings. You've seen that like in markets in Los Angeles, which is one of the worst office markets in the country. There's just been a fire sale. They don't want to go through and do workouts in those situations. So certainly the capital charge goes up. I think over time, interest rates and default rates are very closely correlated. But at the end of the day, 40 basis points right now is not near an all-time high at all. And we've been in a higher interest rate environment now for the last, I'd say, 3.5, 4 years. So it depends again on what sorts of properties are your underlying collateral. I think that's why our thesis at Affinius is that even in a stressed, meaning higher interest rate environment, you're going to see growth in rents in industrial, self-storage, retail, multifamily that can help when those loans come due for the refinance risk. If your net operating income is growing up, you can weather the storm if you went from a 4% mortgage to today's 6.25% market.
Thanks, Alex. Gene, this one's for you. You mentioned earlier, you talked about single stock volatility and how that has increased. Insurance companies are increasingly looking or focused on downside protection. How does your strategy seek to manage downturns during periods of market volatility?
I guess the short answer is we manage it all the time. That the simple aspect of it is, our business is one of we buy convertible bonds that are near par. They've got good downside protection, upside participation. If the stock runs, which we've seen a lot of so far this year, that bond gets up to a point where maybe it's at a dollar price of 170 or 200. At that point in time, you no longer have the downside protection within the bond. So the natural process of our discipline is we sell that bond, buy something else that has the downside protection that's closer to par, whether it be a new issue or another bond that kind of moved into that space. So we always kind of have that downside protection. And it's easy enough to forget right now that we saw that earlier this year, which was a parallel to last year, that in the spring we had a big downdraft in the equity market, on the order of 10% this year, a little bit bigger last year. And in that kind of environment, our portfolios did a great job of protecting on the downside. And it was a function of that, just optimizing the downside protection within the structure. And that allows you to be around when the market rallied unexpectedly post the invasion.
Thanks, Gene. If you were advising an insurance CIO today, what would be your strongest argument for allocating additional capital to your strategy versus other strategies over the next 12 months?
You have three key choices within corporate leverage credit, which is high yield, leverage loans, and private credit. And when I say private credit, I mean the higher octane, higher leverage area. So it really comes down to your view on what you want in your portfolio. And I think that the first step out of investment grade, I think moving into high yield is a easier discussion given the quality migration that I mentioned earlier, and also the lower duration element. So in my view, the number one risk to income markets is interest rate volatility and inflation. And in high yield, you'll be migrating out of investment grade into high yield, which is a very low vol asset class, which has low duration and higher coupons, which protect you in an inflationary environment.
Okay. Same question to you, Alex.
Yeah, I think an argument for commercial real estate is fundamentally, even if you're on the credit side of things, real estate is an inflation hedge. So as inflation is going up, you will see rent growth. That depends on whatever the property type is. Some will be higher than others. But at the end of the day, there's an embedded inflation hedge in those rents that go up and that will tend to move with inflation. The other piece of it too, commercial real estate is something you can literally put your arms around. It's a hard asset. There is intrinsic value even in whatever the type of property that it is. As maligned as office buildings have been across the country, and a lot of them deservedly so, a lot of those now in certain markets and municipalities are getting repurposed and they're turning into multifamily or some other sort of use. Even I've seen office buildings turning into self-storage. So, for those that are, owners of real estate that can be creative and have some capital, there is fundamentally some value in whatever you're doing. So those are the two main reasons, I think, aside from the yield and some of the asset liability matching characteristics, why commercial real estate makes sense in an insurer's portfolio.
Thanks. Going back to the volatility theme, maybe the easiest projection we can make is that given all the moving pieces in the world, be it geopolitical risks, inflation risks, et cetera, the likelihood is that volatility remains high for the foreseeable future. Net, that's a good environment for us in terms of what we do and how we can monetize that.
Thank you. If you would all please join me, a round of applause for that participation. And moderating this session, and appreciate your active participation.